So as you may have noticed, recently we've had a lot of stock market volatility with the onset of tariffs from the Trump administration and corresponding retaliatory tariffs involving some of the largest U.S. trade partners in the world, Canada, Mexico, China. And this has the markets really concerned. And as a result, we've seen a lot of volatility and some dividend stocks have dipped substantially. However, as a dividend investor, I'm not panicking about this at all. In fact, I'm excited about it because it just gives me an opportunity to buy more dividend stocks at an attractive starting yield. It's because I don't really care. Again, I don't attribute my success, I don't measure my success by the growth of my portfolio value in the near term. Sure, in the long term I do, but in the short term, I really don't care. All I care about is growing my passive income. And so when high yield, quality dividend growth stocks go on sale, it is an opportunity for me to lock in higher starting yields and compound my income even faster. So in this video, I'm going to cover why the latest market dip is a buying opportunity for dividend investors, two of my top dividend growth stocks that are undervalued right now, and how these stocks combine high yield, strong balance sheets, and strong growth specifically from the AI boom that I expect to drive significant value and dividend growth for me over the long term. So if you love passive income and long-term wealth building, watch this video until the very end. And if you appreciate deep dive analysis like this, please make sure to smash that like button and subscribe to my channel so you can get future dividend insights coming up. Thank you very much. So why should dividend investors buy this dip? Well, again, the market just reacted to Trump's announced tariffs, sent stocks tumbling lower. But as a long-term dividend investor, this doesn't worry me at all. In fact, it excites me. Why? Well, because market volatility creates numerous opportunities to buy high-quality dividend growth stocks at discounted prices. What is the contrast here? Well, if you own stocks for capital gains, a market dip does really impact you. However, if you own stocks for the passive income, a market dip doesn't really bother you. In fact, it lets you buy more income. It's kind of like saying, if you buy the cow for milk, if you're buying a cow to milk it, why do you care what the current price of cows are, right? Because you're not buying it to just flip around and sell it. You're not even, don't necessarily care about the price of beef because you're not looking to slaughter the cow and sell the meat. You're just wanting to get more milk out of it. And so, if anything, the declining price of cows should be celebrated by someone who's getting them for their milk, because then you could just buy more cows and get more milk at a cheaper price. And so it's the same with dividend investors. And today I have two top tier dividend growth stocks that I'm buying right now. And both of these companies, have investment grade balance sheets with low debt and strong liquidity, and they generate steady cash flows from defensive, recession resistant business models. On top of that, they benefit from AI-driven infrastructure growth, which positions them for long-term growth in their dividends and their overall intrinsic value. And on top of that, they offer high dividend yields at the moment with double-digit growth rates moving forward. Let's break these down. The first one I'm going to talk about is Brookfield Infrastructure Partners. Now, I've talked about them before. BIP, which is the main ticker symbol, it does issue a K1, but if you prefer a 1099 alternative, you can invest in Brookfield Infrastructure Corporation. That's ticker symbol BIPC. And here's why I love this stock so much. It owns a world-class portfolio of critical infrastructure assets, including regulated utilities, midstream infrastructure for energy sector, transportation infrastructure such as ports, railroads, toll roads, shipping containers, and it has AI-driven data centers that it's investing in very aggressively. On top of that, it's backed by Brookfield Asset Management, which is the world's second largest alternative asset manager and the world's leading infrastructure investor. And this means that it has access to high quality investments and regular capital by recycling its existing investments opportunistically to generate strong profits and free up additional equity capital that it can then reinvest in new deals and continue the flywheel of compounding returns for investors over time. On top of that, it has AI infrastructure, which is going to be a huge growth driver for years to come. This is because it's investing very aggressively in data centers, which is a booming industry thanks to the AI expansion going on from hyperscalers like Microsoft and Amazon. And I think it's not fully appreciated yet by the market. I think BIP is going to see significant valuation multiple upside as data centers become a bigger and bigger part of its business. On top of that, it has a rock solid balance sheet with a BBB plus credit rating, $5.5 billion in liquidity, an 8-year weighted average term to maturity on its debt, 90% fixed rate debt, which protects it against interest rate hikes in the future, has high yield and strong dividend growth with a current yield of close to 6%, expected dividend growth rate of about 7% CAGR through 2029, and its expected FFO per unit growth is well over 10% per year over that period of time, as well as it takes advantage of contractual rent escalations, opportunistic refinancings, inorganic growth through mergers and acquisitions, and its capital recycling, again, inflation indexed bumps in its cash flows, etc. So again, BIP offers a high yield, defensive cash flows, exposure to AI growth through its infrastructure investments. And as right now, I think it's undervalued. And as a result, I'm locking in this near 6% yield while it lasts. What's the second big dividend growth stock that I like a lot right now? Well, it's Blue Owl Capital. And this is an alternative asset manager with a high growth business model. And here's what makes Owl so special. First of all, it has diversified revenue. It comes from three segments. It invests in direct lending, which includes investing in senior secured loans, which gives it some downside protection during an economic downturn. Also has a GP strategic capital segment, which is similar to private equity. Here it just owns minority stakes in high quality businesses, even some sports teams. And third is its real assets business. That includes its triple net lease real estate portfolio, as well as its recent entrance into digital infrastructure, which is really play on the AI boom. For example, it's building data centers for Project Stargate, which was a recently announced $500 billion program by the Trump administration to build out some critical AI infrastructure across the country, especially in Texas. And in fact, Blue Owl is building out the first data center in Abilene, Texas right now for that project. And so this, again, makes me quite bullish on their long-term growth projections. On top of that, they're more stable than some of their peers like Blackstone, for example, because 91% of their management fees come from permanent capital, which again gives them a much more stable cash flow profile. 100% of their distributable earnings are from fee-related earnings. Again, quite stable outlook, as opposed to relying on much more choppy carried interest for some of their returns, in contrast to companies like Blackstone that lean much more heavily on carried interest. They also have an investment grade balance sheet with the BBB credit rating. I honestly think they should have a higher credit rating than that because they've got very low leverage, significant liquidity, no major debt maturities until 2031. They also have high yield and explosive dividend growth with a dividend yield of about 4.5% right now, expected dividend growth rate of 15.7 according to analysts, a CAGR of that through 2029. Management guides for even higher potential dividend growth, and their expected earnings per share growth over that time. Again, from analysts, it's a 17.8% CAGR. From management, it's going to be about 20% or higher over that period. So again, with Owl, you get a very powerful mix of current income and high growth. While its yield is a little bit lower than BIP's by 100 to 150 basis points, its dividend growth rate is several hundred basis points higher, at least expected, than BIP's is, which makes it a pretty powerful dividend growth machine and total return player. So there you have it. When markets are dipping and you're seeing stocks like BIP and OWL crashing, that's when I get excited rather than scared. And so as a result, I'm buying these kind of stocks quite aggressively right now. And between these two, you're getting a weighted average dividend yield of about 5%, a little bit more actually, and double-digit expected dividend per share growth moving forward. And so as a result, these stocks offer a perfect balance of high yield income today and compounding over the long term. So with that in mind, what's your strategy today? Are you buying the dip? Are you running for the hills? Are you sitting on your hands? What's your approach you're taking? Do you buy dividend stocks during this time? Or are you trying to wait for a bigger crash and looking to buy even some other names that maybe still are a little bit overvalued today? Let me know in the comments below. And again, if you enjoyed this video, please smash that like button. Helps me reach a larger audience, and subscribe to my channel to get my regular updates on dividend investing. Thank you so much. See you next time.